Thank you for checking out this month's market update for the month of March. Harry, how did the markets do last month?
Last month we had a little bit of a mixed bag. North American markets were slightly positive, European markets were slightly negative, and Asian markets were up and down. So they were a little bit of a mixed bag. David, what do tighter financial conditions mean for investors?
Yeah, we've certainly seen financial conditions beginning to tighten. The Bank of Canada raised rates in March, so did the Federal Reserve in the United States. And anytime we have financial conditions getting tightened, that just basically refers to central bank monetary policy becoming tighter. So basically, 2 years ago when the pandemic first happened, the central banks, both in Canada and the United States, really lowered interest rates to all-time lows. So they made financial conditions easy. They loosened financial conditions. And so that made it easier for people to, get through the lockdowns. It made them easier for them to get loans. It made them easier for people to spend money. Now what's happened is all the money supply has become so large because of the easy financial conditions that now inflation is rearing its ugly head. And so prices for goods have skyrocketed. Inflation's at a multi-decade high in Canada and the United States. And so now central banks are forced with the decision of having to tighten financial conditions. So interest rates are going to go up, and the market has priced in quite a bunch of interest rate hikes for the rest of this year. What does financial tightening mean for investors, Harry?
Well, financial tightening for all of us as investors, really means that we're all going to have a little bit less money. I mean, generally what happens is the government wants to control the money supply. So when things get a little hot, they start raising interest rates. Well, when they raise interest rates, you and I and other people have maybe a car loan, maybe a mortgage, some type of debt. Well, that means that debt is going to cost us more money. So if we were spending $1,500 a month on a mortgage and $300 a month on a car loan, and interest rates have gone up, maybe we're paying $200 or $300 more a month on servicing that debt. Well, what does that mean? That means we have $200 or $300 less money to spend on other things. And so that's exactly how the government controls the economy, is if things get too hot, they raise interest rates to make sure that people have less money to spend on other goods, which controls the costs of that. The other thing that happens is look at what's happened to real estate. Well, real estate market's gone absolutely crazy. Well, why? Because borrowing money didn't cost very much. And if it doesn't cost very much and you're paying 1.5% on $1 million, well, that's only $15,000 a year in interest. So most people can afford a lot more debt when you have interest rates that low. But again, if you push interest rates up and it becomes more costly to end up debt servicing that, that's going to have an effect on real estate and the costs and the values. So the government's also hoping that these higher interest rates will not only slow inflation down, but will start bringing down some price on some other assets like real estate. On a positive, though, if you own bonds or GICs, now you're going to get a higher income stream because you're going to get a higher interest rate on those, and that's going to provide you with more income or a higher income stream from those investments. Mm-hmm. David, how should investors position themselves in inflationary periods of the time that we're seeing right now?
Well, I think that for most people, as we always advise or caution folks, is to not necessarily bet the farm on any particular asset class, right? As an investor, somebody who's planning for your retirement, you want to remain diversified, even though it may seem like certain assets are bound to do better in the next 12 months than others. Inside your portfolios or client portfolios here, like a lot of fund managers have been allocating more to higher quality companies rather than growth stocks. We've seen growth stocks struggle a little bit. So higher quality companies are typically companies that pay dividends. They may operate in spaces like utilities or consumer necessities. things that people require, right? People that need like energy. People need energy. They need oil to put in their car, gas in their car. So that sort of stuff has done better in this inflationary environment. And we've certainly seen some fund managers allocate more to those areas. In particular, Canadian stock market's done pretty well this year because of its high concentration in oil and gas. We've also seen bonds really struggle in the last 3 to 6 months. Like bonds have not performed particularly well, but we feel that the market has pretty much baked in most of the interest rate increases that we're going to expect to see over the next 12 to 18 months. So we've seen yields really pick up, even though interest rates they've only just started rising for the consumer. The market's already priced in quite a bunch of interest rate hikes. And a lot of bond fund managers that Harry and I have spoken to are now beginning to feel like adding some duration into your portfolio is probably a good thing, because interest rates may not, they're going to get to a certain level and they're probably going to start to level off. And so bonds haven't performed particularly well, but going forward, they should offer a little bit more safety if stock markets do happen to continue to decline than they have in the past 3 months.
Yeah, as always, like if you have any questions, don't ever hesitate to give David or myself a call. But one of the things always to remember is that we have planned for these type of short-term markets and volatility into your plan. So we expect them to happen. So when things like this happen, they don't surprise David and myself. We've already planned for these things to make sure that we can take advantage of them inside your portfolios. But please do call us if you have any questions.
Take care.
Bye-bye.